Welcome to today's video, where we break down why you should stop chasing a perfect credit score if your goal is getting approved for a mortgage. We'll separate myths from lender realities, focusing on what actually moves the needle: job stability, cash reserves, and a healthy debt-to-income ratio. If you earn a steady income, for example around $104,000 a year, and you have a stable employment history of 3 to 8 years, the goal is optimization, not panic. Let's set expectations and then walk through a clear, practical action plan. First, we will anchor on the big idea: approval matters more than a perfect score. Next, we will unpack what lenders actually weigh in mortgage decisions. Then, we will expose the zero-balance credit trap and show you a step-by-step method to optimize utilization. After that, we will explain why scores can dip after paying off an installment loan early. We will follow with a 6 to 9 month action plan, sprinkle in quick quizzes to make sure the concepts stick, and close with key takeaways, a summary, and an important disclaimer. Now that the agenda is clear, let's transition to the core message. While higher credit scores can improve pricing and options, many well-qualified buyers overfocus on tiny FICO changes. In reality, lenders heavily value a stable job history, manageable debt-to-income, and adequate cash reserves. If your score is already in the low to mid-700s, small fluctuations are less impactful than your overall profile. Building on that, here is what lenders typically weigh most. First, job stability. Several years with the same employer or in the same field signals reliability. Second, income reliability. Consistent, verifiable income is essential. Third, cash reserves. Having several months of mortgage payments saved demonstrates resilience. Fourth, debt to income. The lower your monthly obligations relative to your gross income, the safer you look. And yes, your credit score matters, but small changes within the 700 range usually matter less than your DTI, reserves, and employment stability. This flowchart illustrates how an underwriter may conceptually evaluate a borrower. We begin with the applicant profile, then confirm stable employment across several years. If that is lacking, the risk perception rises and more documentation or time may be needed. Next, we verify steady income. If income is variable or insufficiently documented, it must be explained or supported with additional records. Then we assess debt to income. If the DTI is within typical target ranges, the profile strengthens. If not, steps such as debt reduction or income increase may be necessary. The next checkpoint is cash reserves, ideally several months of payments. Finally, we consider the credit score. If it is already in the 700s, the focus often shifts to optimization, such as utilization and continued on-time payments. All these components combine into an overall application strength rating. Next, let's address the zero-balance credit trap. If you pay off your card before the statement closing date every month, your credit report may repeatedly show 0% utilization. Over time, that can resemble inactivity, which does not showcase responsible revolving usage and can slow score growth or limit credit line increases. A better approach for optimization is to allow a small balance, ideally under 10% of your limit, to report on the statement date. This technique is commonly referred to as AZEO, meaning all zero except one, and some communities also call it Aziz utilization. Immediately after it reports, pay the statement balance in full before the payment due date to avoid interest while still demonstrating active, responsible usage. Here is the step-by-step method to optimize utilization. First, find your credit card statement closing date. Second, use your card normally throughout the cycle. Third, a few days before the statement closes, pay the balance down to below 10% of the limit. Fourth, allow that small balance to report on the statement date. Fifth, after it reports, pay the statement balance in full before the due date to avoid interest charges. Sixth, repeat this cycle monthly until you apply for your mortgage. Question: to show active use but avoid interest, when should you pay the credit card balance? Options: A. Before the statement closing date so $0 reports. B. After the statement closes but before the payment due date. C. After the due date to give it more time. D. Never pay in full and carry a high balance. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Pay after the statement closes but before the due date. That way, a small balance is reported to demonstrate responsible usage, and you still avoid interest by paying on time and in full. Moving on, here is why your score may have dipped after paying off a car loan early. First, your credit mix lost an installment component, reducing category variety. Second, closing the installment account can lower your average age of accounts. Third, if you only have one remaining account, that account's reporting becomes extremely influential. To rebound, focus on optimized utilization and maintain perfect on-time payments. This pie chart visualizes typical FICO model weightings. Payment history is the largest slice at approximately 35%, reflecting the importance of consistent on-time payments. Amounts owed and utilization follow at about 30%, highlighting why keeping balances low relative to limits is so influential. The length of credit history accounts for around 15%, so preserving older accounts is helpful. Credit mix contributes roughly 10%, explaining the temporary score impact when an installment loan is paid off. New credit is also around 10%, meaning multiple new accounts at once can create short-term headwinds. Now here is a focused 6 to 9 month plan. First, optimize utilization every month by allowing a small balance to report and then paying in full. Second, if you are at least 6 months away from applying, consider carefully adding a single, small account, such as a secured card or a modest installment loan, to restore mix. Third, avoid rapid or multiple applications to reduce inquiries and new account effects. Fourth, maintain job stability and avoid switching roles or industries close to application time. Fifth, protect your debt to income by postponing large purchases and keeping monthly obligations low. Sixth, build cash reserves to demonstrate strong financial resilience to the lender. This Gantt timeline lays out the next 6 to 9 months. Optimization of utilization and building cash reserves continue every month. If diversification is appropriate, a single new account is considered early in the timeline to allow sufficient aging. Avoiding new debts and preserving employment stability are ongoing. As you approach month 7 or 8, schedule a pre-approval check to see how your profile translates into offers. In the final phase, organize documentation such as pay stubs, W-2s, bank statements, and identification. Here we contrast two approaches. The left side chases perfection, forcing immediate gains by driving to zero reporting every month, opening multiple accounts, and reacting to score widgets. This approach often backfires by reducing average age, increasing inquiries, and creating volatility. The right side focuses on approval, aiming for a strong score via fundamentals, letting a small balance report, and paying in full. It prioritizes debt to income, reserves, and employment stability, adds only one strategic account if time permits, and keeps the profile steady prior to applying. Let's ground this with a simple DTI illustration. At $104,000 annual income, gross monthly income is approximately $8,667. Suppose other monthly debts total about $150, and a proposed mortgage payment, including taxes and insurance, is around $2,600. The back-end DTI would be about 31.7%. Lender thresholds vary by program, compensating factors, and underwriting, so this is an illustrative example only. Question: when your score is already in the 700s, which factor typically matters more for mortgage approval odds? Options: A. A 10 to 20 point score jump alone. B. Stable job history and a low DTIC, opening several new accounts at once. D. Letting all cards report $0 every month. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. When scores are already in the 700s, lenders often give greater weight to employment stability and debt to income than to small score differences. Before we wrap up, here is an important disclaimer. This video is educational and is not financial, legal, or lending advice. Underwriting rules, scoring models, and lender overlays vary by institution and program. Always verify recommendations with your loan officer or a qualified financial advisor. Optimization techniques, such as AZEO, may not affect all scoring models in the same way. Let's consolidate the most important ideas. First, approval matters more than pursuing a perfect score. Prioritize job stability, cash reserves, and a low debt-to-income ratio. Second, Avoid the zero balance trap by letting a small balance report and then paying in full. Third, a temporary score dip after paying off an installment loan is normal and can be countered over time. Fourth, commit to a calm 6 to 9 month plan that emphasizes steady optimization, careful diversification, and building reserves while avoiding new debt. Finally, remember that small score swings in the 700s often matter less than the strength of your overall profile. In summary, you do not need a perfect score to get approved. Optimize utilization instead of obsessing over minor FICO changes. Protect your debt-to-income ratio and employment stability. Follow the 6 to 9 month plan for a more predictable and confident path to closing. Thanks for watching. If this video helped you, please like, share, and subscribe. In the comments, tell us your mortgage preparation timeline and what you are focusing on next. Your feedback helps us make more content that serves you.